Here's the stock Movado. It's trading at $37.65. Had a recent sell-off from about $45 down to $35. And the last time it was at the price level, you can see it generated strong demand twice before, verified by the uptrend away from this price level. Currently, the implied volatility of the option is low. It just dropped, meaning that the options are on sale, the stock's on sale. This is a good time to buy a call option. Call options increase in value when the underlying increased value. When we buy an option, we want to buy as much time as we can to give the security enough time to move in our desired direction. You can see the strike prices right here in the middle go from 22.5 up to 60. And when we buy options, we pay the asking price and we sell at the bidding price. Of course, you can use a limit order and dictate your price that you want, but generally we buy at the asking, sell at the bid price. And you can see these prices go from $16.10 down to 85 cents. Now, new option traders, new beginners usually tend to gravitate towards these cheap out-of-the-money options because they are cheaper. We have this Walmart mentality to buy things that are cheap, and don't forget, you get what you pay for. And options are no different. Let's look at this $55 strike. It's going for 40 cents. Look at that column. We can see the probability of it expiring. By expiration, it has just under 6% chance of finishing in the money. Okay, and as you go more closer to the money, the delta gets larger. At the money should be about 50. You can see it's below 50, above 50, as the price is right between the 40 and 35. And then in the money, it gets more and more closer to 1, the delta. Okay. This means the delta has two important interpretations. The first, the probability of expiring in the money, and the second is how much this option is going to move, given a $1 increase in the price of the security. So, as opposed to buying the cheap 40-cent option, buy a $25 strike at $13.60. This is a lot more expensive, as it should be, because if the stock is trading at over 30 sellers, you have the right to buy it at 25. There's over $12 in intrinsic value here, and it should be over $13.60. So we're paying a little bit of time value there in the option. These are safe bets, even though they're more expensive. And the reason for that is the more expensive, what we pay in money, we gain in probability of profit. Okay, I'm going to show you this. So let's analyze this 25 strike call option. Now every option covers 100 shares of stock. So we take $13.60 times 100 and you get $1,360 for one. My account is set up to do 10 by default, so that's $13,600. You say that's a lot of money. But I'd like to consider the price of the stock, $37.56. You would buy 1,000 shares, which in contract covers 1,000 shares. You'd be paying $37,000, the price of a small house. And then you would get point movement, meaning if the security went up $1, you would make times 1,000 shares. You'd get point for point movement there. We can get the same point for point movement without spending $37,000 by buying a deep money call option. And this, we pay $13,600, and we still get the same point for point movement as verified by the delta of this option is 94.35. So we're getting 94.35% movement. That is to say, when this stock moves up $1, our call option that we pay $13.64 will move up 94.35 cents. Okay? So the probability for maximum profit is 0 because options, price theoretically can go up to infinity, not very likely, however. The probability for maximum loss, less than 1%. How is this so low? Because the price now just would have to move down all the way to $25 for us to lose the entire amount. And that's most going to happen. We looked at the price at the beginning and we saw that most likely at an area of high demand at the price level, and most likely it's going to increase. And it's going to participate in the profits above this. Okay. Now let's look at the cheaper one and see the difference. Analyze this sucker. Still 107 days to expiration. Now this one's a little different. The price for maximum profit is 0 because the price could go up to, theoretically, could go up to infinity. But look at the probability for maximum loss. Whereas the other one was less than 1%, this one has a 98%, 9.6% probability to lose the premium of 40 cents per share. To find the break-even price, we always take the strike plus the premium. 55.44 is going to be the break-even. And the reason this is a high probability for maximum loss is because the security has to go from just under 38 all the way past $55 in order to produce profits by expiration. Okay, and you got this line right here that you could make profit if the stock moves quick enough in a short time frame, but by expiration it's going to be this bottom line right here. And right, most long options are losing bets because the stock most of the time doesn't move as fast as we predict it's going to. So when we're analyzing options, we tend to want to look at the expiration payoff diagram, because that's what we know for certain. By expiration, it's going to be either above this one or it's not. But I want to make a point here. If the buyer has a 90.6% chance of losing the premium, then the seller should have over a 9% chance of keeping the premium. So let's look at that. And it's for the same reason, because the point of losing money is so far away from the current price. It has to move over up to $55 before it starts losing money. We're not getting 40 cents. That's the difference between the bid and the ask price. But there's your 98 probability to keep the max profit. Okay, this is the difference between buying insurance and selling insurance. Selling an option is very selling an insurance policy. Selling an insurance policy. And this one, is selling to, a good client here who has a very low probability of ever, filing a claim basically and using that insurance. So this one has a 98% probability of keeping the premium. Okay, and so that's the difference between out of the money options, cheap options, and get small probability of profit as opposed to buying more expensive in the money options, and you get the higher probability of profit as indicated by this delta column. Now I want to make one more point here before I let you go. Keep in mind that if you were to spend it would be $3,755 at this point, whereas if we were to buy one call option at $1,360, it would be $1,360. So still half price, less than half price, and you're still getting most of the movement as if you bought the security. And that's why options are so good at producing millionaires, is because of the leverage that is there. So when we're buying options, we want to buy deep in the money options, and when we sell options, we want to sell out of the money options. So I hope this was helpful. If you'd like to learn more about trading options and mastering the skill of trading options for income, please sign up for our online option income training program, and we'd be happy to show you and help you accomplish your trading goals. Thank you.